Hi, my name is Harishashra. So in this video, I would like to talk about is capital asset pricing model is still relevant for today. But before we go through that, let me introduce to you guys what this capital asset pricing model is. The capital asset pricing model describes the relationship between systematic risk and expected return for assets. CAPM is widely used throughout finance for pricing risky securities and generating expected returns for assets given the risk of those assets and cost of capitals. So, the formula for CAPM is risk-free rate plus beta in bracket expected return for market minus risk-free rate. So now I will go through about advantages in CAPM. So what is the advantages of CAPM? First, it considers only systematic risk, reflecting a reality in which most investors have diversified portfolios from which unsystematic risk has been essentially eliminated. Second, it is a theoretically derived relationship between required return and systematic risk which has been subject to frequent empirical research and testing. Lastly, it is generally seen as a much better method of calculating the most of equity than the dividend growth model, in that it explicitly considers a company's level of systematic risk relative to the stock market as a whole. So now, I will tell you guys the advantage of CAPM. So firstly, risk-free rate. The commonly accepted rate used as the RFR is the yield on short-term moment securities. The issue is the using of this input is that yield changes daily and it's creating volatility. So the next one, the return on the market. A problem arises when at any given time the market return can be negative. As a result, a long-term market return is utilized to smooth the return. Another issue is that these returns are backward-looking and may not be representative of future market returns. So, is capital asset pricing model is still valid for today or relevant for today? So, what do you guys think about CAPM? For you guys' information, there are few assumptions made by investor to CAPM. So the first one is investor can only require a systematic risk because unsystematic risk has been diversified. And the second one is a single time horizon, which means, for example, a return of 6 months can be compared to a return for 1 year. And a researcher also shown that many investors has criticized the CAPM method, but somehow till today many of investors still using CAPM to compare their portfolios, and this is show that CAPM is still relevant because it is easy to use as a comparative method in comparing stocks. That's all from me today. I hope this video can give benefit to you guys, and I hope you guys enjoy watching this video. Bye bye.